Things appear pretty uncertain in the markets, from crypto to equities, bonds to commodities. Global macroeconomic uncertainty has been pummeling numerous asset classes as investors try to digest what the is going on. Is it inflation we should worry about? Or government debt? Will the Delta variant slow economic growth? Will trade wars help fuel supply shocks? So in my video today, I'm going to try and break down exactly where we are in the current economic cycle and whether this is likely to turn. I'll explain one of the biggest risks out there and how this could impact all financial markets. And finally, I'll be telling you guys how I plan to personally protect myself from this risk. So you definitely don't want to miss a thing. Hold up. I am Captain Crypto, and I'm here with some important safety instructions. Firstly, although I may save you from getting burned on shitcoins, I am not a financial advisor. That means that everything in this safety video is for educational and entertainment purposes only. Clear? Good. Now, if this is your first fire safety demonstration, my name is Guy and I am on call 24/7. On call to cover some of the hottest cryptocurrencies, answer burning questions, and fight the flames of disinformation on the tube. So, if you'd like to have me on speed dial, you can sign up by smashing that subscribe button. Ringing that bell will make sure YouTube gives you a ring when I drop in. As always, time is of the essence in crypto emergencies. Finally, please observe your nearest exits in the video timeline. These will take you to different sections of the video should you be in a real emergency. Okay, that's enough protocol. Let's open the taps on it all. Let's start with a bit of a look at the lay of the land currently. There is no doubt that COVID has thrown one of the biggest spanners we've ever seen into the global economic engine. Last year saw some of the biggest GDP crashes on record. And in response to this, governments responded bigly. Fiscal spending skyrocketed in order to make up for lost production and the increasing unemployment. This took the form of stimulus checks, income support, and business grants. The central banks did not sit by idly either. They literally flooded the system with money as they attempted to grease the economic wheels. So much money, in fact, that at this point you can probably consider it funny money. This was all in order to stave off what many feared could be a global depression. Thankfully, though, things began to turn earlier this year. While these measures were able to avert a dreaded depression, the real game changer came in the form of those vaccines. As countries like the US and the UK started rolling these out, they were able to significantly roll back restrictions. People began to get back to their normal lives, and as such, economies began to recover, and pretty damn quickly. For example, in the first quarter of this year, US GDP grew at a blistering 6.4%, thanks in no small part to the over $3 trillion in fiscal support since the beginning of the year. Things were also good on the employment front. Initial jobless claims have been on a continual downtrend as employers have been on a hiring blitz. So much so that the unemployment rate currently stands at just below 6%, not too far from the sub-4% level we saw pre-pandemic. Things were looking similarly rosy in other countries. Here in the UK, the unemployment rate fell to 4.8% as record job growth and vacancies accompanied our easing of restrictions. The same can be said for certain countries in Europe and Asia. Quite simply, the global economy appears to have gone through a turning point, and investors are looking forward to years of prosperous, virus-free economic growth. Right? Well, not so fast. You see, while governments were throwing the kitchen sink at the problem, I would counter that they also threw the baby out with the bathwater. There were some serious side effects to these measures that are beginning to manifest themselves. The first and most noticeable of these is, of course, the record increases we've seen in government debt. According to estimates from Moodys, pandemic spending added $32 trillion to global debt, which currently stands at over $290 trillion. Now, those numbers may be hard to wrap your heads around, so let's take a look at it as a percentage of GDP. 105%. The highest level of debt since the end of World War II. And it's likely to get even worse. According to forecasts from global data, it's expected to reach just under 125%, which is in fact higher than the ratio that we saw at the peak of World War II. The reason that this lending is likely to continue is because it's currently very cheap to borrow, from governments to corporations and individuals. Interest rates are near record lows. Most of this is thanks to the Fed's monetary policy. Not only has it flooded the system with money through bond buying programs, but it has also dropped the Fed's fund rate to zero. Yup, 0%. On top of that, there's been a surge in demand for US government debt. We see this due to the fall in interest rates on US treasuries, for example. This is also quite contradictory, as generally bond yields are supposed to rise when an economy is in recovery. Now that's something I'll address later. The point of the matter is that this economic growth has come at the expense of these record levels of debt. And the main problem with debt is, of course, the fact that it will have to be paid back. Also, while it may be cheaper to borrow now, there's no guaranteeing that it's likely to remain that way. If rates do eventually rise, it will mean that all that debt will cost a lot more to service. This could lead to a situation in which you have a debt crisis, both on the sovereign and individual levels. If it's on a sovereign level, it will mean that these countries will have to reduce their spending. And reducing fiscal stimulus at a time when countries still remain fragile from the COVID shock is not the wisest decision. Similarly, if it's private sector debt, it will severely hit the pocketbook of ordinary citizens who are supposed to power the engines of economic growth with their consumerism. Okay, so that's one side effect of the pandemic response: record levels of debt. However, there's something a lot more scary than that, and it's what's going on with prices. Yes, I know that I parrot on about inflation constantly on this channel, but it's only because it appears to be getting worse. Month after month, we're seeing consumer price inflation breaking new highs. For example, we just recently had the US CPI data for June come out, and it came in at 5.4%, the highest level in 15 years. Moreover, if we were to strip out food and energy and just look at that core number, the price increase has been the largest we've seen since 1991. Indeed, if you've watched my most recent video on the threats of inflation, you'll know that the CPI measure is fundamentally flawed and undercounting it. That's linked to in the top right, by the way. That's neither here nor there, though. This inflation is pervasive, and it's only likely to increase. That is because of the two main factors that are driving it. The first of those is the demand-pull inflation. Excess money supply over at the Fed means that people have been buying everything from consumer goods to properties and durables. Given the feeling of relative freedom that came from reduced restrictions, they've been more willing to spend. However, there is one much more troubling cause of this inflation, and that is cost-push inflation. Some like to term this a supply shock as well, but it's when prices are pushed up because the costs of the inputs in goods have gone up. Unlike demand pull, cost-push inflationary pressures are outside of the control of the central bank. They are driven by exogenous factors like cost of trade, raw materials, and general scarcity of goods. This has been particularly acute because of the massive impact that COVID has had on supply chains. Closures of borders and factory shutdowns have caused severe disruptions to trade. For example, I'm sure that you're all acutely aware of the massive shortage in silicon chips at the moment. This has subsequently led to a shortage of all types of electronics, and hence an increase in their price, inflation. And it's not just electronics either. Did you know that until recently there was a severe shortage of ketchup? Or that soybeans, which are fundamental ingredients of animal feed? Increased livestock feed costs means increased livestock costs means increased meat costs at the table. It's not just these raw materials either. For example, the cost of shipping goods has also been skyrocketing. The average price worldwide to ship a 40-foot container has more than quadrupled from a year ago. Just think about that. Quadruple. That increased cost is going to make its way into the cost of any good that has been imported. And there's very little that the Fed can do on this cost-push inflation. The only thing that they could do is on the demand pull side, and that would be to draw back the stimulus and raise rates. Now, of course, this could stop the recovery in its tracks and could also push up interest rates, thereby exacerbating that debt problem I mentioned earlier. But the inflation situation is itself not sustainable. It's a concern that is shared by a number of prominent people, including an ex-Treasury Secretary, Larry Summers, and the CEO of the largest asset manager in the world, Larry Fink. Neither of these Larrys are happy. Okay, so that is the very real threat from inflation. But at least we have economic growth, right? Well, for now. As I mentioned earlier, GDP growth has been strong. This has also helped to fuel an increase in employment in the US and other countries. However, despite this, there are signs that Q2 GDP numbers are likely to be slower than Q1. Firstly, you have exactly that happening in China. GDP numbers in Q2 surprised to the downside and showed that the economy grew slower than expected. In the US, Q2 GDP figures will only be coming out next week. While these are expected to be higher than Q1, it is likely to start slowing down towards the tail end of the year. And there are already some indicators of this slowdown in growth. Firstly, you had a surprising fall in consumer sentiment in July. This according to the University of Michigan's Consumer Sentiment Index. It was down from 85.5 in June to 80.8 in July. Unsurprisingly, one of the reasons given for the drop in this sentiment was the rise in the cost of living, inflation. To quote the survey director, quote, "Consumer complaints about rising prices on homes, vehicles, and household durables have reached an all-time record." Then you also had this report in the Wall Street Journal, where they polled a number of economists about their estimates of economic growth for the rest of the year. As you can see, we will see a tailing off towards the end of the year. However, there is something else that could upend these numbers and forecasts, and it's an unpleasant topic in general. I am, of course, talking about the Delta variant sweeping across the world. This seems to be precipitating large case increases in the US, UK, and numerous other countries. There are considerable fears out there that this new surge could lead to more restrictions being implemented in order to combat it. So, now you can see why the Fed is caught between a rock and a hard place when it comes to inflation. A tightening of any sort could drive the economy back into a recession if economic restrictions start to come back in. I should also point out that this is exactly what happened in the 1980s when Paul Volcker increased interest rates in order to slow that inflation. It led to a pretty sustained recession. And speaking of the 1980s, there is a reasonable chance that if things do go south for economic growth and employment, we could end up in a similar toxic macroeconomic environment. Stagflation is rarely ever talked about. That's because economists have always thought that there was a negative relationship between employment and inflation, called the Phillips curve. However, ask anyone who was alive in the 1970s and they will tell you that the relationship is not always negative. During that period, you had sustained inflation with slow GDP and job growth. Moreover, we've had record high GDP growth and employment is stronger than it's ever been. Stagflation is not even possible, they say. Well, yes. While job growth has been incredibly high over the past 6 months, there's no guaranteeing that it continues, especially in light of what I've just talked about. Given these concerns that inflation could be anything but transitory, murmurs have started to fly about whether stagflation is on the cards. For example, one of the loudest voices talking about this is Nouriel Roubini. Now, I am most definitely not his greatest fan, and I know that he's not one of the friendliest voices for the crypto community. However, he does make some interesting points in his most recent opinion piece, which I've linked to below. You then also had similar comments recently by Mohammed El-Erian, the chief economic advisor at Alliance and the ex-CEO at PIMCO. In this interview that he did with CNBC, he said that, quote, "Our biggest worry, which hasn't yet materialized and no one in this market would want to materialize, is stagflation." I've linked to the interview down below as well. It's well worth your time. Another interview that I want to point out was this one that was done by Steve Hanker, a famed applied economist who served as senior economist with President Reagan's Council of Economic Advisors. In the interview with Kitco News, he talked about the current state of the economy and how, if Jay Powell is not careful, we could be clawing our way into a stagflationary scenario. Now, I happen to agree with a lot of these guys. There are a lot of parallels with what was initially going on in the 1970s. In that time, there was a supply shock, high oil prices, that persistently drove higher inflation. Today, our supply shock is, of course, the pandemic and the disruption it's caused to global trade. It's not just that. We're also going to see a massive deglobalization as a result of the pandemic. Countries are likely to want to move manufacturing onshore, and free movement of people is likely to fall considerably. The China-US trade war is likely to intensify as fingers fly. All of these are going to keep adding pressure to prices and slow down economic growth in the medium to long term. And unlike in the 1970s, we have some record levels of debt. Household debt is at all-time highs. Corporate debt is at all-time highs. Government debt is at all-time highs. If rates were ever to rise, we would see mass defaults. Think the 2008 financial crisis on steroids. There's also the risk here of central bank debt monetization. Basically, if countries are in a position where they can't raise funding traditionally, they may turn to the central banks to borrow. This is called monetary financing, and it is right out of the Weimar Republic playbook. If you've no idea what I'm talking about, then I've linked to some resources below for you on that. Even if the US were to think about inflating away its debt, let's not forget that foreign governments like Japan and China own the most of this debt, the latter of which is not on the best of terms with the US. A dumping of this debt could have severe implications, not only on interest rates, but also on the US dollar. And a depreciating US dollar, of course, only adds to that inflationary pressure. I talked about this in greater detail in this video. So, the debt bubble is a terrible position to be in. Doesn't matter if it's your mortgage debt or if it's the debt owed by your country's fiscus. And if we combine this with the increasing inflation and risks of slowing economic growth, stagflation becomes that much more likely. Okay, so that sounds like all doom and gloom. But how should one consider investing in such a climate? Well, I have a few ideas. During the last great stagflation in the 1970s, equities did not perform well at all. In fact, they were relatively flat. That's because if there's little economic growth, companies cannot grow their profitability. Moreover, if you invest in equities that are returning less than the rate of inflation, you're earning a negative real return. This is exactly what happened back in the 1970s. We've also seen that despite the momentum in the stock market over the past year, it is beginning to show signs of weakness. For example, on Monday a week ago, we had the biggest one-day fall in the Dow since October of last year. Delta FUD, it seems. What about bonds? Well, yields are at near record lows already. You're probably not going to get above inflation yield on those instruments. Yes, you can invest in Treasury inflation-protected securities, but you are going to also be guaranteeing yourself a negative yield. Yep, investors are currently paying the Treasury 1% for the privilege of being protected from inflation. Crazy, right? Okay, what about real estate? It's been one of the hottest markets over the past year as people have been splurging on new homes. Sound investment? Well, let's not forget those mortgage debt stats that I talked about earlier. If rates were ever to rise in response to a tightening, we could see defaults which could result in downward pressure. However, there is one asset that has been tested in a stagflationary scenario, and that is, of course, gold. During the late 1970s, it was one of the best performing asset classes. We went from just under $200 in 1977 to over $800 in early 1980. Gold has been, and still is, seen as a hedge against inflation, given that it's a scarce asset. Now, while gold appears to have been all over the show for the past 6 months, in the past 3 weeks it has been in a relatively sustained uptrend. Perhaps this has all been as a result of those inflation fears post the past 3 months' CPI data. Of course, for anyone who's ever watched this channel, you'll know that I'm more of a proponent of digital gold. That's right, I'm still a Bitcoin bull, and that's because I still think it's one of the best inflation hedges out there. Now, I know that it has recently been following the rest of the markets, but that is just because of the general risk-off sentiment out there. It's my view that once these investors begin to realize that there really aren't great alternatives out there, they will be drawn back to Bitcoin. Eventually, the negative rates of return they're earning on the debt will entice them back. It's one of the few assets out there that has a protocol-defined supply limit, one that will never be increased. These are the fundamental factors that give it value. I'm focused on the long-term value and not on the vagaries of the current market. Now it's time to start wrapping this video up, folks. It's quite clear that we're heading towards uncertain economic times. While everyone was hoping that we could finally put the pandemic behind us and move on with growth, it had plans of its own. Now we're facing the reality of not only a resurgence of the virus, but also the side effects of our initial response to it. Inflation is running hot and debt is at record levels. Monetary stimulus has reached the end of its effectiveness and cannot really be withdrawn. The Fed really has its hands tied. Damned if it does, damned if it doesn't. Up until as recently as a month ago, no one would have uttered the word stagflation. However, if growth starts to slow towards the end of the year, then this toxic economic combination will become the talk of the street. Indeed, given the recent falls we've seen in the equity markets, investors are starting to fear slower growth. However, in the stagflationary world, there are very few lifeboats with positive returns. That's why I'm personally holding Bitcoin in a large proportion of my crypto portfolio. As I mentioned, it has all the characteristics I look for in a long-term store of value. Of course, I'm not oblivious to the fact that gold does also hold some of these characteristics. Moreover, it's one of the few assets out there that has proven itself in a previous stagflationary environment. As such, I'm also going to be picking up a bit of gold. There's nothing wrong with a little diversification, just as long as I don't have to touch that filthy fiat. I won't be buying physical gold, though. I'll be buying some Pax gold, which is tokenized gold that's issued on the Ethereum blockchain. Easy to store, transfer, and convert. The best of crypto and gold. If you guys want to pick up some Pax G, or Bitcoin for that matter, then you can do so on Binance, Kraken, and a few other exchanges. I have exclusive deals for you at these exchanges, so check out the links below if you want to take advantage of any of them. Well, that's all I have time for today. However, I would love to hear your thoughts. Do you think we're likely to see stagflation? And how are you protecting your purchasing power? Fire the answers into the comments below. Also, while you're down there, I have something extra special for you. It's my dedicated socials page, which has all the official links to the following: my Telegram Insider channel with daily market analysis, Twitter for the latest from the Bureau, Instagram and TikTok for behind the scenes, and finally, my weekly newsletter. It's here that I share my crypto tips as well as a breakdown of my personal portfolio. So be sure to find that page if you want all that good stuff. And if you guys liked this guy's vid, share the love. Hit that like and tap that subscribe. Ping that bell as well for good measure. You don't want to miss what else I have coming. Well, I hope to see you guys real soon. Sayonara and Satoshi be with you.